Welcome to the next video, and basically what we're doing is that we're going to recap what the GDP figures mean for the US economy in general, probably the global economy, considering last Friday we had a GDP figure of just over 2%, 2.1%. The question one has to ask oneself is, it seems a bit contrary to what we've seen historically before, that as we start the economy, the global economy starts tipping off into recession territory, we start seeing interest rates tapering off, and usually the sentiment has already turned bearish, and rates start coming down a bit late. So if in the United States we're seeing growth at 2.1%, and the current administration and the mainstream media are basically saying our economy is doing so well, and we've got 2.1%, and in comparative EU zone and other parts of the world they're actually starting to get close to recession. So what's going on here? Why is the current administration and the investment market so worried when things look to be so good? And so what I'm going to do is examine the real reason why now. And the problem is that as far as the mainstream media and the administration is concerned, I think investors are really being sold a pup while the smart money is getting out. So, not being negative or anything like that, I would love the markets to be keeping on going up ad infinitum, because it's very easy to trade a market that's trending up all the time. It's much harder when the market flattens out, is volatile, or is going down. So going forward, I think there are too many negatives. I could do 6 to 10 videos on all the negatives, and I could probably do a few videos on the positives, but to me the negatives that are what are going on behind the scenes are much worse, and need to be covered. So whereas, as I said before, that the Q2 GDP looks like they're fantastic figures, and certainly they look fantastic compared to the Eurozone, it's not really the case. So what I want to do is I want to basically show you this particular slide that is it's just a small analysis of where the gains and losses were in the GDP compared to last quarter. Now what we can do is we can see fixed investment is down at minus 0.14%, down from 0.53%. Now that's a change of negative 0.67%. Change in inventories, now that's a very important figure. They're down 0.88% from last quarter, where it was 0.55% positive. So that's a quarterly change, down 1.41%. And then net exports, they're also down. It's negative 0.64%. It's down from 0.9%, and that's quarter on quarter. So we're talking about a quarterly drop of 1.5%. So the main corporate health indicators and USA Inc. are down, and that's not looking too healthy on a quarter by quarter basis. Now, the reason why we get a 2.1% positive, because I believe these figures have been juiced effectively by personal and government consumption. We can see that personal consumption has gone from 0.62%, positive 0.62% to 2.85%. That's one very large figure in terms of consumption. And the government consumption has gone from 0.48% to 0.85%, and equally that's 100% almost increase in government spending. Now this is important because the administration and the MSM aren't looking at what's underneath this figure. Basically what we're getting is a quantitative sort of analysis on the figure, not a qualitative one. So if we look at these particular figures, we can see that we're very much on this quarter consumption driven, and that's got implications going forward, which I'll address later on in the video. Now what I want to do, the next one, and this is often raised by economists and people who are quite interested in which way the economy is going, is the PMI figures, and that's Purchasing Manager Index. And this particular slide is from courtesy of Morgan Stanley Research and Bloomberg, and every one of these figures are worse. So what does this mean? Well, if we look at on the right hand column you can see the red, worse. But if we look at the global one first of all, we can say market global PMI 49.4, and it was 52.6 in 2007, previous to the last recession. And what we've got to realize is that 50, when the PMI is at 50 or above, that's managers have got a healthy attitude towards where the economy is going, and they're more likely to hire people, and also more likely to increase inventories based on a potential probability of increased demand. But that's not the case. People are actually all looking at a negative side of things, and as you can see, these are even worse than 2007. But let's have a look. Let's have a look at the United States, because that's where we are at the moment. And in the United States, it doesn't look so bad in the ISM manufacturing. It's 51.7, and yet in 2007 it was 52.2. But it's still worse. But it's still above 50. And we can see that the other indexes, for example, the Citi US Economic Surprise Index is hovering at minus 37.2, whereas it was minus 6.8 in 2007. So that is an incredible decrease. And look at the trouble we had in 2007. So Europe, let's look at Europe market, the euro area. 46.4, well into underconfidence as far as purchasing managers are concerned, and that was 54.3. We have Bloomberg euro area minus 0.38, and that was minus 0.3. So every figure's worse. And then Asia minus 5.3 and 55.6. 49.3 for the China, 49.3, so it's below 50. 53.4. That's very important, considering that China was the main engine of pulling the whole world economy out with its consumption, basically, and demand for materials and raw materials back in 2007, when it basically went AWOL as far as creating credit stimulus for their economy, and effectively helped lift the world economy out of the doldrums. So we can see, therefore, that the position is worsening in that side of things. Now let's look at these next two charts, and these basically show what the probability of recession is like occurring. Now, of particular interest is the second chart, where we use the 10-year and the 2-year Treasury bonds. And we can see that, according to this index, we can see that there's a 33% predictability of a recession going forward. Now, why is that significant? Because back in 2007 it was 27%. So 12 months before the Great Financial Recession, as I say, it was 27%. So do we have a lead time of 12 months? Maybe. But it's another statistic that's based on the predictive effects of an inverted yield curve, which I've alluded to in the previous video. So we can see that things, as far as some major indicators that aren't lagging indicators, these are forward indicators, are not looking too good, especially, as I said in the first slide. So basically, here's where we have a disconnect that I alluded to in the beginning of the video. So if the price of a stock, a price of a stock should reflect the future cash flows, including profits of those stocks, all things being equal. So if the PMIs are decreasing as per the previous slide, the yield curve is inverted and has remained so for the last few months, why are stocks going up? Well, the answer isn't as simple as a Fed put, because that's part of it. But there are more ominous signs, and some of them I'll allude to in the next few minutes, that aren't so subtly hidden, but they're there to be seen. It's rather like analysing these markets is rather like being a detective. It's looking for the clues. There's always clues that are left at the scene of a crime, and often, well, more often than not, when a market implodes, the criminals have already left the scene. I'm not saying everybody in the market's a criminal, but it's just a metaphorical way of speaking. Well, by the time that the boat has left, in another metaphorical sense, it's too late for the investors, because once the R word, as I've said in previous videos, is mentioned, then markets tend to panic and sometimes overreact, but maybe not necessarily in this case. So let's start building the case with the clues that we have, and by looking at the following slide, it shows that there's been a decline in corporate profits, and this is courtesy of Zero Hedge. We can see that revisions are down, always down, but that's not really the main story here. But the main story is that two things, the two main points here. First of all, that we're looking at 2.25 trillion. That was an estimate revised down to 1.9 trillion. So that's a 225 billion shortfall in predicted profits. And as we can see over the last 5 years, profits have been declining, not increasing. So, and yet, in that same period of time, the S&P 500 has gone up 53%. So what gives here? We basically can look at the fact that stock prices increase on the basis of profitability and interest rates. But what I've mentioned before is there's been no increase in earnings per share. The stock price growth has come from, so has the stock price come from the Fed, right? Yes and no. It's a combination of both. What major, in my view, what a major driver of the increase in stock prices has been, besides anticipation of lower interest rates, is the fact of the participation of major corporates buying back shares. And this is why there'll be a double whammy when things start to get a little bit pear-shaped and the recession word is really touted. Now, according to Goldman Sachs, they're one of their analysts, David Costin, he has estimated that last year we had 880 billion of share buybacks. We're going to have a record year this year of 940 billion. So that's pretty close to 1 trillion. And what he said in his report to their investors was that gross debt grew by 8% year on year. So basically what he was saying, unless the income can sufficiently recover to cover that debt, what's going to happen is that net cash outflows, which are currently 104%, so companies are paying out more than they're making in terms of revenue and profits, is going to really dig deep into the cash reserves and will involve more leverage being taken on. So what does this mean? This basically means we have a recession coming, not if but when. Some of the indicators that I've said before could be 12 months, could be sooner, could be later. I don't have a crystal ball, but I will say that one is coming. And what happens is that during a recession, companies intuitively, what they do is that they will maintain dividend payments, because if they fail to maintain dividend payments, then investors will sell their shares and the share prices will take a much greater hit. Confidence within the shares will decline, especially those that have got very poor balance sheets in terms of over leveraged, because those shares that are passing at the moment because of the Fed interest rate drops can still refinance their balance sheets to the extent that it's not necessarily as big a worry, are going to be highly pressurized when the corporate bond market implodes as well. So what basically happens is that corporates and households in the United States and worldwide batten down the hatches. So this 1 trillion buyback activity in the market's going to stop, and it'll stop with just literally overnight, because basically companies are going to go into survival mode, because basically what's going to happen is inventories, as we've seen beforehand in the first slide, are going to be drawn down. That means they're not going to be manufacturing for those manufacturers that are still left in the United States. So they're not going to be replacing inventories, and that means they're overstaffed, and that means people are going to be laid off. And what this means is that GDP figure, the 2.85% personal consumption, is going to nosedive. And it's a vicious circle. You know, consumption will nosedive, investment will nosedive, the buybacks will cease, and then all of a sudden it's going to start getting worse. But the layers of the onion are going to be starting to be peeled off and showing how volatile and how vulnerable many of these companies are, especially in the last one of the previous videos I did in the Russell 2000, where most of the companies were heavily indebted. 65% that way. So what we're seeing that things are not looking so good for the US market going forward. This GDP figure was not good, no matter what anybody says. You can't say to me that, you know, fixed investments and that side of things going down and inventories going down is good going forward. So we need to keep an eye on this, and I certainly believe that we're going to be in the situation where possibly in a year's time, possibly less, we're going to be looking at a market that's catching up with Europe, either very slow or potentially going into recession. Thank you so much, and I'll see you in the next video. Bye.